All right, let's get right into it. Today, we are breaking down one of the most powerful and, wonderfully simple ways to start investing your money without all the stress and the guesswork. We are talking about something called a systematic investment plan, or SIP for short. So, does this sound familiar to you? You've got some money set aside, you're ready to invest, but then you freeze. You're hit with that huge question, is now the right time? You start worrying, what if the market's too high? Or maybe, should I wait for a dip? A dip that, never seems to actually show up. It's a really frustrating cycle, and honestly, it keeps way too many people from ever getting started. Well, what if I told you there's a strategy that's basically designed to take all of that stress right out of the equation? That is exactly where the systematic investment plan, the SIP, comes in. It's the simple, automated answer to that whole market timing headache. So, what is it really? A SIP is just a way to invest a fixed amount of money, say $50 or $100, into something like a mutual fund or an ETF on a regular schedule, think once a month. No big, scary decisions, no panic buying or selling. The whole name of the game is just consistency. And what's so cool about this is that the concept probably isn't new to you at all. I mean, if you have a 401k at work where money just automatically comes out of your paycheck, you're already doing this. It's built on a really powerful strategy called dollar cost averaging. That just means you're buying shares whether the price is up or down, which over time averages out your cost. It's brilliant. Okay, so you're sold. How do you actually get started? We're going to break it down into a super simple 3-phase journey. And phase 1 is all about getting your roadmap ready. This is the planning and preparing part. And look, this first stage is just 3 straightforward steps. First, you clarify your goals. What are you even saving for? Is it retirement? A house? Then you just gather up your basic documents. And finally, you open an account. See? It's that manageable. And for that second step, gathering your basics, you just need the normal stuff. A photo ID, your social security number, your bank info, and proof of address. Seriously, this is the same stuff you'd need to open a simple checking account. There's no complicated financial paperwork here, which makes getting started incredibly easy. All right, with all that prep work done, it is time for the fun part. Let's move to the next phase, taking action and putting this whole thing on autopilot. This is where you actually launch your plan. Now, this part has 4 key steps. You're going to pick a platform, choose the right fund for your goals, decide on the little details like how much and how often, and then the final step, you set up the automatic transfers. Once this is done, believe me, all the heavy lifting is over. And when it comes to platforms, you've got some great options. You've got your traditional brokerages like Vanguard or Fidelity, which give you a lot of control. Then there are robo-advisors like Betterment, which are perfect if you want a more guided, low-effort approach. You can even go directly to a mutual funds website. The most important thing is just to find one that has low fees and that you find easy to use. And now we get to the one question that stops so many people dead in their tracks. This sounds great, but don't I need thousands of dollars to even begin? Let's just tackle that idea head on. How much do you really need to start? The answer for a lot of platforms is as little as $25. That's it. You can literally start building wealth with just $25 or $50 a month. This was never about having a huge pile of cash to start with. It's all about building a consistent habit. And that just shows you how accessible investing has become for everybody. And now we've arrived at the best part. This is the ultimate payoff for setting all this up. This is the set it and forget it phase, where your personal wealth building machine starts running completely on autopilot. So once you've set up those automatic transfers, your SIP is officially live. It invests for you month in and month out without you having to lift a finger. And that automation is the absolute key. It removes emotion and that constant temptation to try and time the market right out of your strategy. So what does monitoring even look like? Well, it's incredibly simple. You do want to glance at your statements maybe every few months just to see the progress. But what you absolutely don't want to do is get addicted to checking the daily price swings. That just brings all that stress right back into your life. The single most important thing you can do is just stay consistent and let the plan do its work. When you boil it all down, it really just comes down to this. A SIP is designed for discipline and for simplicity. It's pretty much a perfect fit for anyone who wants to grow their wealth steadily over the long term without having to become a full-time stock market analyst. So just remember this. The barrier to start investing has truly never been lower. The path is clear, it's simple, and it can be completely automated. It really just requires taking that one first step. Your future self is waiting. So what are you going to start building for them today?
Let's talk about building wealth. I know. It can feel like this huge, complicated thing, right? But today, we're going to show you a surprisingly simple way to put your financial growth, well, basically on autopilot. You ever look at the world of investing, with all the charts and the jargon, the stocks, the bonds, the markets going up and down, and just feel overwhelmed? If you do, you're not alone. So many people feel like you have to be some kind of Wall Street genius just to get in the game. And that feeling, it stops a lot of us before we even start. But what if I told you that's not really true? What if there was a straightforward, almost set-it-and-forget-it method to grow your money over time? Well, there is, and we're about to break down exactly how it works. All right, let's get right into it. First up, we're going to explore what makes this approach to investing so much simpler. So what is this automatic investing we're talking about? It's really just this. You set up a regular automatic transfer, say every month or every payday, from your bank account directly into an investment, usually a mutual fund. That's it. The magic word here is automation. You're taking yourself and all the second guessing out of the equation. And you know, what's the potential upside here? Well, if you look at history, diversified stock funds have returned, on average, somewhere between 8 and 12% a year. Now, of course, the past doesn't guarantee the future, but those numbers really show the long-term power of being in the market. Automation is what lets you consistently tap into that potential. Okay, so the idea sounds good, but now for the million-dollar question, right? Which fund do you actually choose? Don't worry, we're going to build a little checklist, a toolkit to help you make a really smart choice. Number one on the list, and this is a big one, what's your timeline? If you're investing for something way down the road, think retirement 5+ years away, you can typically afford to take on a bit more risk with things like stock funds. But if you're going to need that money sooner, say in less than 3 years, you'll probably want to stick to more stable, less volatile options like bond funds. All right, next up is a term you are going to see everywhere, the expense ratio. It's basically just the annual fee a fund charges you to manage your money. And listen, these percentages might look tiny, but trust me, over decades, they can take a huge bite out of your returns. And that brings us to a super simple but incredibly powerful rule. Keep your costs low. For the kinds of basic index funds we're talking about, you really shouldn't be paying more than 0.5%. So aim for an expense ratio of 0.50%, or honestly, even less. The lower you get that number, the more of your money stays in your pocket, working for you. And to finish off our checklist, yeah, you can look at a fund's performance over the last few years, but don't just chase whatever was hot last year. It's often way smarter to go with funds that have been around for a while, run by experienced managers. And finally, you know the old saying, don't put all your eggs in one basket. Spreading your money across 2 or 3 different funds is a great way to diversify and manage your risk. Okay, so that's the theory, but what does this actually look like in the real world? Let's make it a little more concrete with a few examples. Now, a huge disclaimer here. This is not investment advice, okay? These are just illustrations to help you connect the dots. So if you're comfortable with higher risk for higher potential growth, you might look at something like a Vanguard 500 index fund. If you want something more in the middle, a balanced fund could be a good fit. And if you're more conservative, a total bond market fund is a common choice. Feeling a little more confident about this? Good. Because getting this whole thing set up is probably way easier than you think. Let's break it down into 4 simple steps. Seriously, it is this simple. 1, open an account with a major brokerage firm. 2, use the checklist we just talked about to pick your fund, or maybe a couple of funds. 3, log into your new account and schedule those automatic transfers from your bank. And 4, this is the most important part, just stay consistent. You let the system do the work for you. This quote right here really nails it. Automation is what unlocks the incredible power of compounding. You know, that amazing process where your earnings start to earn their own earnings? Just think about it. A simple $100 a month with an 8% average return could grow to over $150,000 in 30 years. That's the magic of compounding, and automation is the fuel. Okay, before we wrap this up, let's just go over a few final tips for success just to make sure you really get the most out of this whole strategy.
So here's some final food for thought. If you are brand new to all of this, a simple, low-cost S&P 500 index fund is a fantastic place to start. It's instantly diversified. Also, take advantage of the great free research tools out there like Morningstar or NerdWallet. Make it a habit to check in on your choices once a year just to make sure they still make sense for you. And finally, if you can, use accounts like a Roth IRA or a 401k to get some amazing tax advantages.
And there you have it. We've taken this thing that feels so complex and really boiled it down to a simple, automated system that anyone can use to build wealth. So I guess the only real question left is the one on your screen. Now that you know the path, what's your first move going to be?